Okay, so a little spoken context on my latest video that I put out. It was basically showing clips, one clip per year between 2016 and today. Basically, so just think about this, right? All the way back in 2016, what did we have? We had China wanting to be included into the index, and they also wanted to get away from an export-based model to a consumption-based model. Now, this in and of itself, wouldn't that not create a supply chain issue? Because if the United States, if a lot of their stuff is imported from China, that would create a big problem on the quote supply chain for the United States. If this is true, which it is. So with this also comes an opportunistic side, because if you look at the consumer base in China, it is humongous, huge. Then a year later, in 2017, we have Mark Zuckerberg working with China to help develop their cyberspace infrastructure, likely to go hand in hand with their planning on being consumer-based modeling. Then in 2018, there's further discussions about opening up China's market and being allowed to move in. Some quotes that were taken, and they're talking about their investing space in their bond market. It's an untapped market at this point in time, zero exposure to it globally. And remember, the whole point is global stabilization in the global economy. So if you have China wanting to be a consumer-based economy, not an export-based, that's, again, going to create a huge problem for the United States. We might need to come up with an infrastructure package, and you can see how that makes a lot of sense now, and how a lot of these policy decisions kind of add up. Then you have 2019, where we talk about the deacceleration of China, and warn of a trade war being a potential stumbling block to the opening up of their emerging market economy, which is exactly what we've seen. A stumbling block. Except it was COVID-19 and a trade war, but there is no trade war. 2020, COVID begun. Chinese regulations are underway in the real estate sector, forced deleveraging via the Three Red Lines policy that was established in August of 2020. BlackRock discusses China and credit liquidity and basically risk concerns when it comes to Chinese securities, and they shrug it off because not only did they warn us of the upcoming policy of the Three Red Lines, but they begun helping the Fed as China was deleveraging their real estate sector. BlackRock was doing what? Going over and buying up all of the houses. So then you have the China delisting fears, and those are ignored because most of people on Wall Street are very, very well aware, and again, they're ignored because of the markets being intertwined. And then lastly, we have this very, very timid-looking analyst that looked like she was nervous as hell, saying that the data shows that institutional international investors are moving into China right now, despite the current fears and narrative in the media, which is, again, follow the money. The money is clearly moving somewhere. Now, you take all this in, and then what is this trade deal, this trade war that's been going on since 2016? What was the deal? The deal was this. You list your companies in our markets, and we will build you a bond market. And that's exactly what they've done. They've built them a bond market. Because if you look, and you look at all of these ADRs that are here in the market, look when they were listed. This one was listed in 2020. Go find me one that was listed prior to 2016, other than TAL and some of these long-standing education ones. There's not many of them. Most of these ADRs were listed 2016. And we're talking consumer. So things like, Dada. That's consumer cyclical. Dada was listed in 2020. We look at DD. We all know DD was just listed. KC was listed in technology. And we remember, because of Mark Zuckerberg, they're obviously going to be entering into a technology space. So information technology specifically. So that opens up IoT, Internet of Things, which is going to be a huge ordeal in China soon. It's opportunity. It's emerging. The definition of emerging is soon to be prominent. So, again, you look at the education stuff, the consumer defensive, TAL, go to EDU. This stuff's been around a while. We're talking, this one got listed in 2005. edu. Should be the same thing. 2006. Go to. I think they're more recent. Yeah, they're 2019. But yeah, I mean, most of them are new. So you list your companies on our exchange here. We build you an index. We build you a bond market. We open it up, and it fixes the global scale, which is exactly what they've been telling us this whole time in the policy documentation. Oh yeah, and by the way, beautiful, beautiful. Jasmy's up 48%. Anyways, that's the context. It makes sense. And then what do you have going on now? COVID lockdowns in China. Now get this. So you know what happened with our internet in January 2021? It was claimed that everyone put their stimulus money into the market. Let's just say this narrative is going to be the same thing in China. If you look at the internet users in China, the internet user base in China is more than double the entire United States population. So just put that into your mind and then look at the opportunity that could arise from there. Yes, I'm still holding GME, but I'm also holding several more GMEs at their very low pricing, as most of these are now under $5. Just saying, it's something to think about. And that's my reasoning for it. So just wanted to point that out.